The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. Global government bonds get some much-needed relief, courtesy of the US Treasury announcing plans to double buybacks at the longer end. But steady your horses, I'll go through this in a short while. But President Trump bemoaning the Fed, for high rates. It didn't take long, did it? Amid rising debt burdens.
We have interest rates that are they're actually artificially high. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
Meanwhile, President Trump threatens economic consequences against any country that helps or does business with Iran, adding the US is preparing crushing economic warfare. ECB Chief Christine Lagarde warns the US retreat from the global order is hurting Europe's growth trajectory, urging policymakers not to repeat the mistakes of the dotcom boom in the AI era.
All right, one or two things to say about the bond market. Should we do it now? You ready? You sitting down? Got your coffee? Okay, let's go. The US Treasury has stepped in to try and stem the sell-off in Treasuries, announcing it will at least double. Wow, this is amazing. This is amazing. It's going to at least double the size of its liquidity, support, buyback operations for bonds dated from 10 to 30 years. That must be a massive amount of money if they're going to double it. We'll come to that in a moment. The announcement pushed the yield on long-dated debt sharply low, with the 30-year Treasury yield down around about 5.2, 5.18% this morning. But how much money? How much is the doubling? You've got to know, guys. We've got to know this, haven't we? The doubling is going from, wait for it, a mighty $2 billion, I think, to $4 billion. Wow, that's going to really stave off all this selling at the long end, isn't it? Oh, hang on a second. Hang on a second. How much money does the US borrow every year? I don't know, a couple $1 trillion? But that's right. They're going to double from 2 to 4 billion their buyback of the long end. That'll save everything. No. Hang on. What's the deficit? There isn't it. 6%? Oh no, don't worry about that now, because they're going to double it from 2 to 4 billion at the longer end as well. How much money does the federal government spend every year? What, $8 trillion? Don't worry, because at the long end, there's going to be an extra $2 billion to stave off those concerns as well. Hang on, what's the interest payment in the United States from the government? What? 1.5 trillion a year for 2026? That's okay though, don't worry, because the Treasury is going to buy an extra $2 billion at the long end. It's all solved now, okay? So don't worry, the show's over. Anyway, that 5.18% yield is closely tied. I mean, do you see what I'm saying? Do you get you get my sarcasm? Good, okay, right. It's British irony, okay, in case you don't understand. The yield is closely tied to the rate Americans pay for things like mortgages and car payments. So it is perhaps unsurprising the Trump administration has moved to try and push rates down as its war on Iran helps push gasoline prices to their highest level ever for August. Hang on, but didn't the president in the headlines just bemoan the government, the Federal Reserve interest rate level, which is way too high? But hang on, at the same time, gasoline price, the highest level in August. Oh, no, the two are totally unrelated. That's right. I forgot. That gasoline price surge has helped hold inflation at nearly 1.5 times the Fed's target. President Trump hit out at central bankers on Wednesday. Oh, stop the clock, you lot. Stop the clock. How long has Walsh been in place? When did he get his confirmation? May, was it, I think? May, June? We knew this would happen. As soon as light follows day and day follows light. We knew that, didn't we? The President Trump has hit out at the central bank on Wednesday. Kevin, you've had a honeymoon period. It's over. Suggesting members of the Federal Open Market Committee hike rates because they like the politics of it. Hang on. You elected Walsh. Oh, I'm really confused now. The Fed hasn't actually hiked rates in more than 3 years and cut them 3 times in 2025, actually. This as the minutes from the FOMC's July meeting were released on Wednesdays, with many officials saying a hike would be needed if inflation doesn't abate. But the US leader insisted rates are too high where they are now.
We have interest rates that are artificial. They're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
What's that? Calm down, Sedgwick. The numbers aren't that big. I apologise. Someone's out there just shouting at the screen. Calm down. So, OK, I'll be more measured about this as well. So the $1 to $1.5 trillion interest payment, it is what it is. The $8 trillion that the Fed will spend this year, the federal government will spend this year, is what it is as well. The $2 trillion of borrowing is what it is. So we don't perhaps worry about it quite so much. Oh, but there is another little inconvenient factor out there, and that is that America's national debt, have a look at this, national debt has hit, oh my God, look at that figure. It's almost as if they had it ready for me. $40 trillion. $40 trillion. It's more than doubled since the president's first inauguration less than a decade ago. Let's not be political about this. There's a chart showing whether you're a Democrat, whether you're a Republican, the figure has gone up, OK? And it's gone up also. It's not just about the absolute money. It's about the debt to GDP. And if I said to you we're roughly double what we were at the big financial crisis in 2007 to 2010, our debt to GDP in America now is double those levels, give or take. Now, more than a quarter of that $40 trillion is coming under the President, Mr. Trump's watch, exacerbated by his One Big Beautiful Bill Act, which the Financial Times says is set to push up debt by more than $4 trillion by 2034. So that swelling debt figure now means the government spends a record $1.37 trillion a year just servicing the interest on that debt. I just mentioned that. Now, that's more than the budget for the Pentagon and is more than this year's outlay on Medicare. Anyone else? I'll do so in a minute. Earlier this month, a Reuters Ipsos poll found that Americans now see Democrats as better stewards of the economy than the Republicans for the first time in around about a decade. Don't forget, under Obama, it went up. Under Biden, it went up. And Republicans quite rightly then criticised Democratic administrations for, dare I say it, not getting a grip on the national debt. Now the boot is on the other foot. Bond yields around the world are starting to pull back after the Treasury's intervention. It says here, have a chat. I kind of almost said quite a lot of what I've got to say, but I'm going to talk one or two more things. Anyone else remember the acronym DOGE? Anyone? DOGE. Department of Government Expenditure, wasn't it? And that was Elon Musk coming in to hang on, I'll rip up the vast amount of spending, wasteful spending, that is leading to these big deficits as well. In fact, the big beautiful bill plus Doge was going to actually get that deficit down from... I remember Kevin Hassett on CNBC many, many times. He'd probably still say the same thing now. Get that deficit down from 5.9, 6.3, whatever it is, down to the 3% level that they wanted to get to. Where's the evidence that this is working? And that's what's worrying me, Ben. It's 8 minutes past, you get a word in. Good morning, my friend.
Hello, good morning, everyone. I am here. I mean, it's at that point, just pick up on that point, the FT's done some calculations on this, and the federal debt, the gross federal debt, has grown by $3 trillion over the past year alone, and they reckon that's the fastest pace outside of the pandemic. So, to your point about efforts to try and scale back the growth of the deficit and how much is being added to the total debt pile, it doesn't seem to be working. The other issue that comes to mind with this, there's something I don't understand, and I don't know if...
Welcome to my club.
I don't know if anyone else understands this. Why does the US government, borrow? Because they don't have enough money to cover the spending that they need based on what they're getting in. They've got less coming in than they've got to need to spend. So when they say they're going to buy back treasuries...
Yeah, it's to keep the liquidity going in the longer end.
But where's that money...
On the longer dated stuff, the older stuff that's not got quite so much...
Where's that money coming from to buy the debt? Because presumably they're having to borrow to then buy the debt, which sounds like a bit of a house of cards.
Sounds a bit like financial alchemy, doesn't it?
It does. It really does.
There is another factor. Oh, sorry, please.
And I was just going to say, I mean, I suppose there are lots of people sort of looking at this thinking, I don't want to ask this or point out, because if there's an obvious answer, I may sound very silly. But actually, to me, it doesn't make sense.
The obvious answer is always the right answer, Ben, and that's why I don't understand a lot of what's going on in the world at the moment. I hold my hand up. Any regular viewer knows I've had my concerns about the debt profile of very many places, by the way, not just the United States, for a very long time, including China, including Europe, including United Kingdom as well.
Because it's not the central bank doing it. It's not. This isn't the Fed we're talking about. This is the Treasury. And I suppose one way to do it is you borrow at the short end to fund some of this longer dated bond buyback. But if you're doing that, it's effectively like taking out more on your credit card to pay down your mortgage.
What does Kevin Walsh want to do? He wants to be a good steward of a growing economy that doesn't have financial market ructions as well. One of the ideas that Kevin Walsh has had, and he said many, many sensible things, he said in his affirmation hearings, confirmation hearings, in my view. One of the things he wants to do is have a smaller balance sheet for the Federal Reserve. That is the big thing. Quantitative easing works in periods of time, but it should not be something to lean on the whole time as well. How on earth, given this backdrop, does Kevin Walsh significantly reduce the size of the Federal Reserve balance sheet? And that is a question which I haven't had an answer for anyone. It sounds great in principle. Why have we got this huge asset base of bonds that actually is distorting the broader market? But actually, what we want, it seems, given the Treasury's action, is a little degree of less market and a little bit more degree of distortion. But if that's the case, when does the real battle tanks of the Federal Reserve have to start either A, reinvesting the bonds that expire, or actually then just buy more bonds outright as well, increasing the balance sheet rather than declining the size of it as well?
Well, yeah, I mean, it's the question that I think we've asked multiple times to the guests we've had around this desk with us, and said, how can he possibly achieve that well-established goal that he set out before he even took the job as chair of the Fed, that he wanted to trim the balance sheet? How can he do that without further pushing up these yields that were already at nearly 20-year highs? And no one seemed to be able to give any sort of set of circumstances in which he would be able to do that. Maybe, you could argue, if there were an end to the conflict with Iran, and fears about inflation eased, and the Strait of Hormuz reopened, and oil started flowing, the inflationary fears that are feeding into this might have...
And here's the point. Here's the dispelling of the myth as well. US interest rates are 3.75%. It is not Kevin Walsh, it is not Jay Powell, it is not Lisa Cook, it is not the FOMC more generally that is setting that 10 to 30-year paper as we speak on a daily basis. It is the market turning round and saying, we are concerned, we're not flashing red, but we are concerned about the $40 trillion. We are concerned about the 6% deficit. We are concerned about the $1.5 going to $2.5 trillion interest payment that you're having to do on this, which wipes out Medicare and or defence as well. It is the market that is saying, we are not going to lend you money at the longer end unless you give us a better yield. It is not the Federal Reserve which is dictating that price as well. And by the way, the answer to the question is 97 days.
What was the question?
The question is, how long did it take for Trump to start getting annoyed at the Federal Reserve's policy under Kevin Walsh?
Yeah.
Because I'm pretty sure I've heard the president saying in the intervening period, Kevin's doing a great job, we've no problem, we're going to be hands off, he knows what he's doing. And that's pretty much the same kind of time frame that happened back in 2017 with Jay Powell.
Yeah, and I think...
Who was appointed, of course, by Donald Trump.
Just picking up on your point about it's the markets, it's the bond markets, it's the bond investors who are...
It's the buyers.
It's the buyers who are setting it. They can often be portrayed as, the villains. Politically, they may be portrayed as the villains, they are causing problems. But I don't think, I don't think the bond market is an impatient one. They don't necessarily even want to see it solved now. They just want a roadmap and to feel that the government is serious and has a credible plan for dealing with the growing deficit.
Absolutely.
And that would be enough to placate, to my mind, to placate the bond markets and ease some of the pressure. That's what
this show would be very, very happy for the plan to work. I don't want to see financial cataclysms. I don't want to see bond market reactions. I want my own personal life, my family's, my children's, my friends. I want them to have a nice, easy world where actually they're not worried about high inflation, where they're not worried about bond markets stopping them getting mortgages at decent rates as well, where they're not worried about their student loans, what have you. I genuinely want this to work. But if the big, beautiful bill, which is cut taxes, and the rest of the policies combined from this administration continue to create a 6% deficit rather than the targeted 3%, then the plan isn't working and it's just storing up more problems for the next administration and then the next administration, which, again, Democrat and Republican politicians have failed to address. This is a combined problem. This is not a Republican-Trump issue on its own. This is everyone failing to do their duty for the next generation. Steve.Sedgwick@cnbc.com. I will take all your emails. Genuinely, I will look at them all, the good, the bad, the ugly, and I will look at them and I'll try and get back to as many of you as possible, either in writing or indeed in the show as well. Paul, you've been writing in this morning. Gary, you're always writing in as well. Thank you very much indeed. There's quite a lot of you out there who probably feel as exacerbated as I do about this. In the meantime, oil.
Yeah, and I should say, he does reply. He does reply. Sometimes when I'm talking, you'll hear the keyboard tapping away. That's Steve replying to your email.
I'm not as bad as it's supervising producer Katie, who destroys her keyboard when she types. I'm a little bit quieter than that.
Anyway, yes, as we were saying, let's have a little check on what's happening with oil. And it is up again in the session, around about 0.1%. It had jumped yesterday about 0.2%. Brent crude was up at $91.62, so adding to that advance. Just to say, if you're tracking oil across this week, both Brent and US crude up between 3.5% and 4%, on pace for a second positive week in a row. So unsurprising, given the lack of clarity about any sort of route out of the conflict between the US and Iran. In fact, US President Donald Trump has said Washington will launch, quote, the most crushing economic operation ever against any country targeting Iran. Trump hit out at Tehran for failing to reach a deal to end their conflict, pledging economic warfare and isolation on an unprecedented scale. Trump also threatened tremendous consequences for any country that helps Tehran evade sanctions, urging an immediate halt to oil smuggling, swap lines and cash transfers, among other channels. The US leader's threat of economic D-Day came without details on specific measures or countries. Speaking ahead of his announcement, Trump addressed potential economic measures and praised the US naval blockade of Iran.
We have things that we could sanction. We have very draconian sanctions, and we'll see what happens. Right now, the strait is open. A lot of boats are coming through. The blockade has been 100% successful. No boats have gotten into Iran, but they are getting in for other places. But we'll see. We're going to see what happens. It'll either be extremely good and oil prices are going to drop like a rock, or we'll continue to do exactly what we're doing. You know, they were talking about $350 a barrel, and it's today $84, $85. And we are getting a lot of oil out. But the other thing that's happened is people have found other alternatives, which they never thought about. Texas, Alaska, Louisiana, and other places. In addition, a lot of pipelines, record numbers of pipelines are being built. So I think the Hormuz Strait's not going to be quite as important as it was in the past.
What's that? You gave Ben 2 minutes of airtime in 18. Yeah, I know. It's too much. Yeah, I agree. Okay, thanks.
Bring Steve back in. Let him get a word in edgeways. What?
Well, the thing is, one of the greatest things about a journey is at least you're aware of your own faults sometimes. You know,
it's not a fault, it's a quality.
I can look in the mirror and see my own faults sometimes.
It's not a fault, it's a quality, and we admire
Bless you, you're very sweet. Coming up on the show, he has to say that. Coming up on the show, OpenAI's CFO says the company will be public by next year or sooner, according to sources. We shall discuss. Plus, Heathrow loses its crown as Europe's busiest airport. We're going to speak to the CEO of the new title holder, and it's a beautiful airport. I was there quite recently, actually. And we'll speak to the CEO of Novonesis after the group ups its full-year organic sales growth forecast. Esther Bessent coming up in a few moments. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back. Shares in Moderna surged 177% after an experimental skin cancer vaccine developed with Merck produced positive initial results in its first late-stage trial. Data showed the mRNA injection, along with Merck's immunotherapy treatment, met all key goals in phase 3 trials in more than 1,100 patients. Speaking to CNBC, Moderna's CEO, Stéphane Bancel, explained the individualized nature of the treatment.
It's individualized, which is you will get a different drug. If you're diagnosed with melanoma today, and I'm diagnosed by the same doc, you and I will get a different chemical. But we're going to look at, take a biopsy. We're going to sequence all the letters of the DNA of your cancer cell. We're going to do the same for your healthy cell of your body, most blood work. We're going to compare electronically where the mutations are. And we designed and we aim to improve an algorithm to pick 34 mutations that we believe are the most important in your tumor.
Novonesis has reported first-half organic sales growth of 8% amid solid performance in its food and beverage and household care units. The Danish biotech firm raised its full-year sales growth forecast to between 7 and 8%. Always a privilege to speak to Esther Bessent, who is the CEO of Novonesis. Esther, congratulations on the numbers. They look incredibly solid to me, but just tell me what the highlights are for you and where you perhaps need to do some work still.
Thank you, Steve. Always a pleasure being here with you. Yes, we feel very good. We are in a good place. We deliver another quarter of extraordinary performance, another dot on our trajectory of a say versus do. 8% growth, it's a good number, the growth of the first half. And that strong growth coupled with the good momentum, also what we see in Q3, and our read of the market and the strong pull on demand for our solutions puts us in a good place. And raising the guidance of revenue to 7 to 8%, with also aiming to the high end of the profitability and strong cash flow. Important to mention that we also announced a multi-year share buyback program while we continue to invest for future growth, sustainable long-term profitable growth and share value creation for our shareholders.
Esther, you and I have talked a lot about the Christian Hansen merger, which is, about 2.5 years ago now, the start of that process now. Have you finished extracting all of the obvious benefits from that in terms of synergies and what next for the combined company?
Oh, we're not done. We're just starting to see the tipping point of the amazing combination and the power of biology. We see the powerful combination of enzymes and microbes together in dairy, not only enabling higher yield, higher productivity, cost savings for our customers, but higher protein, taste, texture, palatability, extending the shelf life. We see the combination also in a higher protein or low sugar, lower salt baking goods. We see the power of the combination in new innovation coming in beverages, where we're growing in a difficult market with innovation. We see the power of the bigger company in emerging geographies and having the muscle and collecting the fruits of the investment we've made in commercial resources, getting closer to the market in commercial geographies and in emerging geographies and getting that capitalized into growth. So we are in a good place, but we are not done.
Esther, it's Ben here. Nice to see you as well. I just wanted to get a little more detail on the this new denim bleaching product that your company's come up with, because it is such an imperative for any company involved in chemicals to try and reduce the environmental impact of the processes. And it sounds like this gives consumers what they want, that classic denim faded look, while lessening the environmental impact. You just explain how big a deal this is.
I don't think I can add any better words to the way you describe it. Maybe if anything, it's not at the expense of cost. Novonesis continues to prove the world that making a better planet and driving a good business, they go hand in hand. We drive productivity improvements, cost efficiencies, as we come in with solutions that replace chemicals, coming to solutions that enable healthier products, cleaner labeling food. And the beautiful denim example you show is just a way of showing that there is innovation also in a market where we can continue to make a difference.
In terms of the way that the company's using AI, if at all, how big a role is it playing in terms of research and development in developing chemical processes and speeding up getting new products to market?
Absolutely. AI is a beautiful friend for us. We have embedded AI across all the enterprise, but particularly in R&D, where we're capitalizing on a very strong foundation. We have more than 100,000 strains in our libraries. We have more than 50 million structures of enzymes. And we have all the data on how those microorganisms, those proteins perform at the fermenter, and also the performance they bring at the customer. We used to use machine learning, so we have that mindset and that structure already in place. And now with the more powerful LLMs, with AI in place, we're simply capitalizing on that. We already see the fruits with more shots on the goal. We have reduced the length of R&D projects from years to months. We're increasing the impact and the power of the solutions that we bring. And you saw that reflected a little bit in the sales, but only we see it on the strength of the pipeline. Today, more than 20% of our solutions, they have our revenues from solutions that are less than 5 years old and contributing to growth. AI will be a further boost of that efficiency gains, of that breakthrough of innovation, continue to be closer to our customers and continue to provide value-added solutions.
Esther, you have come from the same place I do as well. It is heartbreaking to see the yields diminishing on so many agricultural areas of the world because there's not enough water, because the climate is just too hot as well. All kinds of issues there as well. I know that what you're doing and what your team are doing is part of the trying to work out solutions. But do you have concerns that the climate change challenge that you and I have looked at so much, and we've been privileged to be at so many COP meetings as well, that actually that challenge is being lost despite the best efforts of innovation?
I'm going to unfortunately repeat myself here. I see no change on the momentum for biosolutions as an enabler of a healthier, better planet. Because we don't make a trade-off between productivity, efficiency, and then benefits for the planet, benefits for healthier people, benefits for healthier foods. And that momentum has never been that strong. And now, building on the previous question, with the power of AI, with the capability of bringing even bolder solutions faster into the market, we continue to be, and the investments we've made in the past on people, on R&D, and on CapEx, we feel in a very good place to continue to contribute on healthier planet, health solutions that enable healthier foods, and being our contribution on moving the world into a better place as we're driving shareholder value creation.
And I've seen the buyback as well, so that's fascinating for a lot of the shareholders. Esther, I'm going to leave it there. Time has beaten us. Lovely to see you as ever. Thank you for joining Ben and myself. Esther Bessent, who's the CEO of Novonesis. Thank you. And as I'm sure a lot of you are aware, Esther is incredibly generous with her time in our Conversation on Executive Decisions podcast. And I'll be brutally honest with you, and I hope Esther doesn't mind me saying this as well. She finds it very difficult to kind of talk about herself rather than the business as well. So that made the conversation even more valuable. And it's available in all the usual podcast places. It was a brilliant conversation with a brilliant CEO. It's available on CNBC.com and our YouTube channel.